This session is about the way I prepare myself every day. So, unveiling the profitable trading secret. So, I will explain to you what I do the whole day. Behind what you see, you will see a lot of other work I do, but I'm giving you the ideas what I do, and I strongly believe that a lot of things are there. Like when I started my trading learning, I met few people. So one of the person I met was named Randall. So he was from Costa Rica, and he gave me some tips or guided me in the right direction. And he said few words. Now when I recall back those words, what he said, I mean he was new also. He was just 6 months senior to me. He started, but he was way ahead, 6 months, but he had captured some basic principles. And before he disappeared from my life, I think he ran away to Costa Rica with his son. He was having the problem, so he told me that you need to do this in order to succeed. And I never met him again. And then I met few other people. I met Dan, I met Charles, I met Chief, Todd. So all these guys, they gave me some ideas along the way. Here is the slide by Wallace Wattles. So this two course I got from The Science of Getting Rich. So there is a book called The Science of Getting Rich by Wallace Wattles. So he wrote this book maybe in 1901 or 1910, something like that. So I came across this book, The Science of Getting Rich. Now, when I tell people, hey, you need to read this book 2 hours, and they don't have time, 2 hours, don't have time to read a book for 2 hours, don't have time to even listen audio on the YouTube, don't have time. So if you don't have time to listen to something which is very important or understand, then failure. So read this book, The Science of Getting Rich. So in that book, there are 2 quotes. There are many quotes. So you just grab 2. Leave every person you come in contact with the impression of increase. So deliver some values. When we deliver some values, you are the one who's benefiting. So I try to deliver value to you. I believe in it. And guess what? Who is benefiting the most? Me. I'm trying to make you understand this. You get rich by doing things in a certain way. So try to do certain things in a certain way, and you will get rich. The money will pour in. There's no doubt. Think about that. There's other books I recommend that you read or listen by Rhonda Byrne. Rhonda Byrne, The Secret. So find that or go on Audible, or go on Amazon, buy the book, buy the CD, listen to what she's saying. She's not saying, but the experts are saying in her secret book. And what the experts do, she has done the research, and then experts, they take the words out of her secret movies, and then they make it their own, and they say as if they are saying their own. No, it's not. So yesterday I was talking to the same person. His name is Andrew, and Andrew was telling me, hey, do you believe in this? I said, yes, I know. I believe in it, and I read it. I listened to it from the Rhonda Byrne's CDs called The Secret. So he said, yeah. So have you read that? I said, yeah, I read that. So the gurus are out there taking Rhonda Byrne's work and teaching as if they are the one who discovered. So read that CD, listen to that CD, or read the book by Rhonda Byrne called The Secret, and you will learn something. Now another thing, so this is something was told by Chief. So I fear not the man. So he gave me the quote of Bruce Lee that you need to practice one kick 10,000 times. So think about also Muhammad Ali. So Muhammad Ali will punch one guy 20 times or 20 guys one time. So think about this. Muhammad Ali, he will punch 20 guys one time or one guy 20 times till that guy is knocked out. So you really need to punch, one skill, and then adopt another one, then another one, layer, create the system, and then you connect it. So the trading is bunch of systems. little bit here, little bit there, and then you combine it, make it one system. You master one, then and it's done. Maybe 70-80%. You leave it there, then you learn something 70-80%. Then you connect it, then you go and learn something else related to it and see if it's connected. Make it one whole system. So that's what you need to do. But you practice one kick at a time, or punch one guy 20 times like Muhammad Ali, not 20 guys one time. So think about that, the difference. The other day I asked my daughter, what is 2 + 2? So she just said 4. I said, no, 5. When I said 5, she said 22. So 2 + 2 is not 4, it's not 5, 22. In other words, you can, the same trade, same system, you can, every day is you can make 2 + 2 22, not 4 or 5. Also, another the magic in trading is you really need to find where the big boys are, where the smart money is coming in. Not like retail guys going and chasing something up in the sky and buying 50 contracts on a Robinhood app, because I can trade on Robinhood. So I open my little tiny screen on the phone, I push the button and I buy 50 contracts. And then when it loses money a little bit, because I bought 50 contracts, I just panic and I close it. And then I move on. So don't do that. Have a system. Figure it out how to hunt the dinosaurs. The dinosaurs can run but cannot hide their footprint. So these are the big boys. These big boys, something called demand zone, something called supply zone. So these guys, these big boys, or the retailers, they are coming in at the price which is called fair value. So it is fair for them when the certain stock or certain instrument drop at a certain price, and the demand was there before, and the demand is there now. So they come in and they start to scoop. So that is the beauty of trading. You need to figure it out. Where is the demand zone? Where is the supply zone? So have you mastered that? And not only that, then once you know that, then you say, okay, are the big boys coming in? Is there a volume? Is there something going on? So all day long, I'm not pushing myself to find the trade. I'm very relaxed. I'm doing my thing. I have 8 monitors right now. I used to have 14. I have 8 monitors. One is a 49-inch monitor, so I cut down the other monitor. So I'm just monitoring my thing. I have 3 computers, laptop, 2 iPads, 3 phones. All of them are doing something. And if the trade comes, it comes. If it doesn't come, it doesn't come. The trade can come at 12:45, or the trade can come right at 15 minutes after the market open. And how the trade comes? Because it meets certain criteria. I see it. The dinosaurs are there, and then the trade goes into certain further criteria. Evaluate it. Check. On a scale of 1 to 10, it needs to qualify 9 or 10. Not 8 or 7 or 6. Don't go for mediocre, because there is always something. You have an open position, maybe that is a 10. You may want to add more to your existing position if it's moving nicely, rather than open a new position, which is on a scale of 1 to 10 is like 5, and you're messing up just because the trade is there and mediocre, and you're taking it. You don't have to take the trade that day. You just relax. Maybe the existing trade, you can put some money into the existing trade, just a little bit, add to it. Maybe a different strike, different month, something like that. If you already have a position in Meta, you're already in profit, but it drops. So it drops. Is there an opportunity for you to add more? So go and look for it. Tesla drops. You're already in the Tesla, and it drops. Instead of panicking to get out, you just close some trade. You have the money. You deploy a little bit to the existing trade. So you build your existing by figuring it out, which position you already have and where the money is coming in existing position. So you don't need to create new positions. So who are the big boys? These are the big boys. I'm sure you know the institutional players, the hedge funds, the sovereign funds, pension funds, high frequency traders. They influence. They have the size. They influence. Now we say, okay, a dark pool, and we don't see any big lots. I don't go and look into like level two or depth of the market. I'm not doing the scalping or day trading or front running. I'm not. So I don't go into this level two or dark pool. I'm so analyze the rhythm. The rhythm. You will see only 100 shares on your screen. 100 because that's the program kicking in. If you want to buy a million shares, you just unleash your program 100 shares at a time or 10,000 shares, 100 shares at a time. In no within the minute that 10,000 shares at 100 will get filled. So if you're trying to figure it out, if this is a big boy buying in volume, is it a Warren Buffett behind, or is it Ray Dalio, whoever it is, you can. So, but you must have some other way of figuring it out where the traders can come in and where do you see the pickup in the volume, whether it's 100 or 1,000 or 2,000 or 10,000. Now, mastering keep pattern. This is another thing I learned, and I was told that there are thousands and thousands of patterns. I mean, if they if for someone is if you point someone towards the sky and ask, they will tell you, "Hey, it's a dog. Do you see anything?" "Yeah, I see the dog." And then the person will say, "No, I don't see the dog. I see the cat. It's a cat over there." So for me, it's a dog. For you, it's a cat. Or for you, it's a cat. For me, it's a dog. So all these patterns are subjective. So the thousands of patterns out there. So if you just rely on patterns, it's not enough. So you need to have many other techniques and systems. So I will show you few, the list down, and then you cannot master everything. There are 10,000 indicators. You name it. There are indicators after indicators. People have created indicators based on price and volume, price and volume. So you take this two way. In this way, you multiply by 2, and then you divide by 3, and then you get this. For 2 plus 2, divide by 4, you get this. If this, you get this. This is my indicator. So many indicators, so many moving averages, so many studies. So which one works? So identify which one works. So you have to spend some time in figuring it out. So it's key patterns or key systems, key indicators, volume analysis, everything, support resistance, everything, trend lines, can go into play in identifying which one is demand your attention. Now, when you put in the effort, the end result should be that you develop a system for yourself, which you can trade comfortably. So you turn on. So my routine is simple. Start your day with some routine. So start your day fresh. Take shower, make coffee, do some meditation, turn on the computer, read some news, turn on the TV, see something, I talk to my team, I look at the pre-market. So everything is ready. I'm ready. So the ready means that I have this system to develop my own trading style or my own what I'm looking for. So what is developing a low risk trade idea? So low risk trade idea is not about the stop is at 5 cents and you will lose little. The low risk idea, the definition of low risk trade idea, again, this is what I learned from the experts. Over the period, I learned whenever I spot someone from whom I can learn, I go, like if the person asks me, can you come on your head, not in your car, on your head, start walking, I will do that because I know I need to learn from that person. So people, they just want a shortcut, learn something here, there, YouTube. So it's not gonna work. So YouTube will not teach you. You have to teach yourself. So this is the paragraph I learned. A low risk trade idea is an idea with a positive expectancy that's traded at an exposure level that allows you to survive the worst possible contingency in the short run so that you can achieve the long-term expectancy of the system. So the basic, this definition is saying that you have a trading system, which you call it a low risk trade idea, that has a positive expectancy, meaning when you take all the trades and calculate all the gains and the loss, the net result is positive. So people ask me, hey, what is your win rate? So what is your win rate? So I can have a win rate of 90% and it still lose money, or you can have a 90% win rate and it still lose money. And how? Because this 90% trade is like you're making $10 in each trade, and then the one trade, is a big loser. You lose like $200. So in 9 trades, you made $10, $90, and in the last trade, the 10th one, you lost $200. So what is the win rate? Win rate is 90, but you still bankrupt yourself. So don't do that. People trade any stocks. People looking for shortcut. They are looking for some breakout at 35 cents. I buy like 50,000 shares at 35 cents, and I will sell it at 50 cents, and then buy 35 cents, buy 50,000 shares, and load it up, and I will sell it at 50 cents. I will make so much money, and then what that stock does, it doesn't go from 35 cents to even 36 cents. It goes to 5 cents, and then it goes to 0 cents. Why? Because people are just looking for that volume spike. This is a volume. Look at that. I need to chase it, and boom, 50,000 shares at 35. Because 35 cents, how low it can go? It's so cheap. 35 cents, 50,000 shares, and then wipe out the account, and then they go back to work wherever they're working, McDonald's or whatever, driving truck, or maybe I have a job in IT. They go back, bring some money more, and then they go for another one, 40 cents a share. And then they'll lose, and then they come back. So what they don't have is this system. So they never learn. So you need to have a system where over the long run, when you take all the trades, develop from your trading system, even though if you have a short term drawdown, you still come out ahead. So think about if you buy something like 35, I'm just giving you examples, 35 cents, 50,000 shares, that one trade, that can make you money. Maybe it goes to 50 cents or $1 and you made money, but eventually you get caught and then lose everything. So that is not the trading system. It's just chasing something. So don't do that. Work on for the long term, develop something which you can use for the long run. Such a system that you can even hand over to your children. Think about it. Hand over to your children that, hey, children, I developed this system. If you follow this, you will make millions and millions of dollars, not 45 cents, 50,000 shares, and then from 45 cents, it goes, not even go to 46 cents. It goes to 0. And I have done it. One time I bought, like 12 years ago, somebody introduced me to these penny stocks. So there was a stock called Java. So I think I bought it for like 20, 30 cents. I bought maybe 10,000 shares. And then it went to 80 cents. So it jumped to 80 cents. But I held on. It's going to 80 cents. They were coming up with some coffee or something. And then it's 0. So it's 0 right now. So that was my first and last penny trade stock. So if you develop a system, keep working on it and develop something which you will become filthy rich and you can hand over to your children. Are you or your grandchildren, are you working like that? If not, then maybe you're just coming to the market one day and leaving the other day. So develop the written low-risk trading game plan and then execute. So that's what we have done. So that's what I've done for the last 15 years to develop the low-risk trading game plan and then execute it and also deliver it to my members. I mean, it's so It's just very easy. It's very easy. It's a what is it? It comes naturally. So crafting a low risk trading game plan. So trading rules. So I have my own rules developed the whole thing. So I know my rules. Trading checklist. I know my trading checklist and perfectly play the trading game. So in the morning when you wake up, you open your computer, you do your thing, and then you're ready to execute the trade, whatever comes. And if it doesn't come, then doesn't come. Or you have your open trades and you are ready to exit. Exit protocols are triggering. So do you have a low risk trading system which and you can capitalize on it? So if you don't, you're wasting some time. Develop edge. Do you have any edge in the market? The edge could be as simple as going to bed early, waking up early, staying away from all the vices. Think about if you buy a horse or this the stallion or something. Would you feed that horse chocolate or milkshake or alcohol or a wine or beer? Will you feed your horse those things? So why are you? I mean, you can do it, but if you feed it, it will come and affect. The result will come towards your trading. So for me, I don't do all that nonsense. And for me, I think it this way, that not only I am responsible for my trading results, for my family, for my children, and for my members. So if my members see me, now she drinking alcohol, okay, and he went to bed late, he's not taking care of his health, he's eating junk food. So think about that. How would you feel if you see me doing that? Or I post my picture sitting on a beach, two beautiful girls on my side, one on this side and one on this side, and I'm sipping something, I'm relaxing. Would you think it's for real that I'm doing that? No. So develop some edge in the market. Don't do that, those kind of things. Stop the trade to control risk. Do you have a process to stop the trade? So this is very important, and you need to work on mastering the stocking of the trade. So if you master the stocking of the trade, you control your risk, you increase your profit level. You can increase if you master the stocking process, your profit. If that trade makes you without stocking, you still make the money. Let's say $1,000. If you stock the trade, you can double your profit. So I'll explain a little bit how the stocking works. Be very precise. So stocking the trade to control the risk, you become very precise with entries and exits, and then you execute your trading ideas flawlessly. Then also, do you have a process of monitoring your open position? How do you monitor? Do you monitor in a detailed manner, or do you monitor in an overview manner? So do you have that? If not, then it's time to work on this. So we do that, and we send you the trade alert. We send you the trade alerts right at or closing of the trade, right when the time is right there. So right there. Today we opened Amba. I think we bought Amba call, and within 2 hours, send you the trade alert to close the trade. In 2 hours, it hit the target. So think about that. Being aware of market conditions. Do you have a system to monitor the market conditions? So I developed. So the three things Randall told me. So one of the things Randall told me was that markets. So I understand now what he was telling me about the market. So 5-6 years ago, so I've monitored the market all my life, but there was not a system. So I said, okay, how can I have a mathematical system of monitoring the market? So not only monitoring it on the screen, but my mathematical model telling me that this is the condition of the market. So I started working on the Excel worksheet. Okay, I need to work, develop the formula, feed the data. Used to sit till midnight and then come up with what actually the market is doing. Not only, I mean, it's easy to, everything looks easy when the market is moving in a nice fashion. Okay, yeah, market is moving up. But when the strength is coming down, or when the volatility is increasing or decreasing, what is the what happened today that tells you that you need to step back? Is detecting the change in the trend. So that is very important. Detecting the change. You can get in the middle of the market when the market is moving up, and then you. But the time when the market is about to make the change, do you have a system? So that is another thing, and you can sign up just for $97 for the whole year. And the reason I give you for $97 for the whole year, so that you are aware of the market conditions, what you are getting as a report, that's what I am also looking at it. So I put it in a nice one-page format just for you to look at and read it. And so people say like this, so why do I need this market report, Naushee? And why do I waste my $97 when I'm relying on your trade results? So think about that. I'm sending you the trade alert, but if you know the market conditions, you can increase the exposure in your trade. You can decrease your exposure in the trade. I don't know your portfolio size. I don't know what is going on, but by being aware of the market condition, you can capitalize on it. That this is the time. Maybe you have a $2 million portfolio. I have members who have $2 million, $5 million, and I have members who have a $10,000 portfolio. So there is a big difference between the person who has a $10,000 portfolio and the person who has a $2 million portfolio. If a person has a $2 million portfolio and he's seeing the same trade, he can and have the access to this report, he can increase his bet size. He knows that he's not making a $1,000, $2,000. He is blessed. So he may have sold the business and now he's trading. So he can increase. So do you have a process of increasing and decreasing your bet just based on the market conditions? So if you don't, then you are missing out on a lot of gains. So now I list 12 of the trading systems and strategies. So if there's a separate session, I explain all this because it takes like 2-3 hours just to give you overview of these 12. But I listed here. So listed here the black box trading strategy. So you can buy the black box if it's available to you. Big boys have the black box. They run the program, and based on all the mathematical formulas, etc., they make money. But when the black box breaks, then they also go bankrupt. So just Google. Maybe I create a different session how big boys lost billions and billions of dollars by developing this black box, and the black box failed. So the mathematical model of the assumptions they had behind the black box was not correct, and they thought that they have a foolproof formula, and they lost billions. They wiped out. They are bankrupt. So one such person ran a hedge fund, and he was a master in commodities, crude. So they were master in the crude, and he was running a big hedge fund. So when I met him, I learned. I attended his one-on-one sessions, and I learned a lot. So he is a coach now, but he lost billions of dollars because he developed the black box, and the black box failed one time. So think about that. Okay. So you can develop your own little black box. So that's what I also have. I feed the data into my system and then come up with my decision. But that black box is not just I'm relying on it. I'm feeding the data myself, and then I'm coming up. I solve some headaches. That's what it is. Now, another system you can have is a chart pattern trading strategy. So chart pattern, the head and shoulder, the double top, the the triple top, double bottom, triple bottom, all that, the flag, wedges, etc., neckline break, and this and that. So you can master all the chart pattern trading strategies you want and see which one helps you. Band trading strategy, you can master the band trading strategy where you sell when the stock goes at the top of the band, and you sell, buy when it hits the bottom of the band. So if you have that strategy, you can combine it with the other volume indicators and other indicators and make something work. Trend trading strategy, you can use the trend trading. So these days the stocks are trending. So this is the time to make, I mean, since last week of October, the market has given the buy signal and is still moving. So there's a lot of stocks are trending. So when the stocks are trending, you can deploy. When you figure it out, okay, there is a trend. So now your job is to deploy the trend trading strategy. But remember that the trend, people spot the trend very late. When the definition of the trend is two higher highs and two higher lows are formed, or three higher highs and three higher lows. By the time they spot that trend, it's already late. The stock has already moved so much, and they are chasing it. So instead of chasing it, if you identify that this symbol has established a trend, do you have a system of a proper pullback? When the proper pullback occurs, and then you go for it, then maybe if you are already in the trade, you add more to it. So the scaling in process, do you have a scaling in process? The support and resistance, do you have a way of identifying a support and resistance? So this is very crucial to identify support and resistance because it's based on the historic battle. So historic battle between the buyers and the sellers. So somebody won and somebody lost. So identify those. So this is a static support and resistance. You're looking at the past, but it plays role. If something happened in the past at certain price, the chances are, so you are basing a chance it will happen again. And if it's happening again, then you're taking advantage. So do you have a system of support and resistance understanding? Do you have a system of dynamic support and resistance? So the support and resistance are changing as the time goes by. Can you identify that? Do you like breakout strategy? Maybe that is your thing. So people say, oh, I trade breakout. So what they are saying is, I'm a Momo trader, and when the breakout stops or pullback occurs, then they don't have any strategy for exit. So be careful with the breakout. So breakout of 52 weeks. So the stock is just breaking out. So if the stock is breaking out, fine, and you get in. Do you have a way of, when the stock reverses, do you know where to get out from loss? And when the stock is breaking out, making a, let's say, 52-week high, do you have a way of figuring it out, the target? Because it's very easy to figure it. It's easier to figure out the target, exit target with profit, when the stock is trading in a previously traded landscape. So just think about the landscape. You have previously traded. So you know the territory, so you figure it out the territory, but it's hard to figure it out the target when the stock is trading in an uncharted territory. So do you have a method of analyzing it? Same way for breakdown strategies, gap up strategy. So I love gap up, and so gap up or gap down, especially if the market is trending. Let's say if the market is trending and then the gap up occurs, so what do you do? Do you have a way of just chasing it, going all in at that time, or initiating a small position, or waiting for the gap to fill? So that's one way. And another one is, how do you know this gap is at what state? Do you have a way of analyzing the gap at the proper state? Do you know if this gap will be not the pull, you will get caught at the open? You buy it and then you see the pullback occurs. So analyze, have a method. Do you have a method of when you see you are already in the trade and it gaps up? That's amazing. So now you need to ask yourself who you are at that time. when the stock gaps up, you ask yourself, am I trading it for long term, or am I a short-term trader and I'm trading options, and my option will expire in 4 weeks, and this is my opportunity to exit. So this is opportunity to exit, or this is the opportunity to buy more. And if you buy more, am I supposed to buy the same strike, same month? Maybe not, because the strike is way in the money. So maybe you need to close your existing position, open a new position. Maybe you open a next strike. Maybe you hold your existing position for another 1 or 2 days, but you're opening a new position for another 2-week run because it's a new catalyst. So all that, you have to mentally prepare yourself that what would you do when you spot the gap. Not all gaps are powerful. Now, if you reverse it, the gap down strategy. So what would you do when the stock gaps down and you're already in a position? So what will tell you that you need to exit, or this is another opportunity for you to buy, but not now? What will tell you that the gap down has stabilized and now it's going back up, and you need to add more to the position, either even at the below your entry price, or averaging it out. And then another one, the gap reversal. So do you have a method of capturing the gap reversal, especially when the market is uptrending? When the market is uptrending, like right now, and the stock gaps down. So when the market is trending upward and the stock gaps down, there must be something related to that stock, and it may not be that bad. But some guys are thinking and they are selling it. So think about that. That could be your opportunity to buy more. So market is trending, the stock gaps down, you're already in a position, or maybe you're not in a position and you spot it. So you start identifying the key area for the stock to conquer. That will tell you that this is a time to initiate a position or add more to the position. So think about that. So I do that all day long. Intraday reversal strategy. So intraday reversal, when the stock gaps down, or not gap down, it's just overall the market just got some news and everything is just pulling back. So and then we say no, that bad news was not a bad news and everything is all right, and then the stock starts to move up. So intraday reversal. So intraday reversal, what would you do? How do you identify that that this intraday reversal is genuine? Maybe it's not genuine. Maybe you initiate a little position and then you combine the intraday reversal with the help of support and resistance. So you see, you spot the intraday reversal, then you're taking help from the support and resistance. You identify support and resistance, and maybe you go and see the chart pattern. Maybe you see a double bottom forming. Maybe you are a candlestick guy and you also read the candlesticks, and then you say, okay, I see the chart pattern is confirming. I see this candle is confirming. I see this is support, and then I see the volume is building on the buy side, and I see the overall market is moving to the upside. So I will initiate a new position. But you don't. So you initiate a position. Now, when you're initiating a position, do you have of identifying how much you would invest, or would you go all in, or you rather scale in little by little? So I do all that every day. Moving average. So moving average breakout. So you can develop a moving average breakout system. 8-day exponential moving average crossing above 13-day, or 13-day crossing 21-day, etc. So develop, maybe you develop this system. So think about that. So I gave you example of the 12 trading system. Now, after you identify all that, so I'm just giving you that what is required. You need to know what trading symbols you will trade, because there are 20,000 symbols. So don't think that you can trade 20,000 symbols, or you will be able to capture them and make money consistently. You will make money 1 or 2 days and then you will wipe out. So don't do that. Identify your trading symbols in advance from some criteria. So I was playing chess with my kids. So I used to name it hardcore and core stock. So I gave this name. So I tend to relate the things with the real, so you can relate it. So I said, why not I name my symbols into knights and kings and queens and bishops and rooks and pawns. So there are certain criteria for the stocks to fall into different categories. So the kings are those the biggest stocks, like like a Booking.com or LRCX or something like $2,000 stock. So I'm not trading options on the $2,000 stock, but I watch it. I see what they are doing. So keeping them in front and seeing what's their performance. Now the knights are the one which I'm trading, and I give you example of knights. I call them knights. They are the ones. So here's the list of knights like Apple, Airbnb, Amazon, AMD, Baba, Baidu, Coin, CRM, Meta, Tesla, and then there are others. I listed only like 8 or 9 of them here. So these are the stocks which are. So if you keep this, they are moving. If not all of them moving, something is moving. And if you have the system, you will be able to capture one of these for the short-term move. So something is moving out of this, and they have a certain rhythm of moving, catching. You can even go to the tick chart for these stocks, so you can see how they are moving even on the tick chart below the 5-minute chart. So tick chart, you can analyze their option volume, so you can see the volume. The spread is very narrow. The volume is huge. Open interest is there. Everything is aligned for to trade for the swing. So these are knights. I call them knights, and I keep them all of them in front of me throughout the day, because I know I cannot miss when they move. I shouldn't be missing it. Kings. So these are the kings: Adobe, Broadcom, Booking, Costco, Intuitive, Lulu, Now, Shop. So if you look at the prices of these are big. So if unless you have millions of dollars of options portfolio, these are big stocks, like $3,000, $4,000 for the option. So don't trade. Maybe you trade shorter term, or you create the spread. So I don't trade options on these. Now other ones I call queens. So these are the stocks which are everyday stocks. They are moving. So I call them. There are a bunch of different stocks like Boeing, Caterpillar, John Deere, Disney, Dollar Tree, FedEx, UPS, and Home Depot, Lowe's, etc. So these kind of stocks. So they are moving. They are also moving. So I call them queen, but I don't. I just designate them not as in night, because night are very liquid and options are liquid. So I keep them, call them knights and queens. Now then there's a basket of financial stocks. So you need to monitor the financial stock. You need to monitor the oil stock. You need to monitor the biotech stock. You need to monitor the chip stocks, the technology stocks. So all the retail stocks. So understand what is going on any given day in a different sectors. Based on these criteria, I've done the homework, and I continuously add or delete a stock. So you need to be constantly understanding a new symbol, and if something not meeting the criteria, delete that symbol. Just get rid of it. Just think of it as just a symbol. Just a symbol there. You call it a dog, cat, lion, tiger, whatever you want to call it. Just a symbol. So it doesn't meet your criteria, you get rid of it. So some stock, you look at it. They were a $200 stock. Now they are $2. Or they were $10 stock. Now they are trading at $15. So something has changed. So figure it out how you will analyze different symbols and bring them. So you're always looking to add a new symbol, because that symbol will make you money. Now another thing you need to do is the time interval. So this is what I also do. So I send you the trade alert. How I analyze all the symbols on these time frames. You don't have to, for swing trading, you don't have to do the monthly time frame. It's too long. But if you can keep it, it's good. I start out with the day time frame. So everything starts with the day, because that's where you see it on the day. You have to immediately go, even if you spot a symbol on, let's say, as small as 5 minutes, you see something moving. But then you have to immediately switch your chart on a day time frame. So something which is looking good on a 5-minute time frame may not be looking good to you on a day time frame, because you see the day time frame and you say, okay, it's way overbought. it has been moving for so long. So pay attention to the you go immediately and analyze it. Maybe you go and look at the weekly time frame. So if they confirm that there's enough room and the stock is behaving in a way on a 5 minutes or 13 minutes, then you start to monitor that trade, because you know the day time frame and the weekly time frame is telling you that it has a potential. But if there is no potential, then the 5 minute, 13 minute is just a noise. But if the stock has a potential on day and weekly, and 5 minutes and 13 minutes, you will say, oh, I love it. I saw that on a 5 minute, and then it built to 13 minutes. Then finally, when it gave me the heads up or the green signal on 31, and I executed it, but I verified on a day time frame and weekly time frame. So I call it, you can call it long-term time frame, intermediate, and then short-term. So think about it: monthly, weekly, daily, and 195. Put it on a long-term time frame, and then you create another time frame, another workspace starting with 195. So where you end, you have to start. So this is all my opinion and belief. You don't have to agree. Where you end in workspace, you have to start in another workspace. You have to start with the lowest time frame where you ended. So if the long term is a monthly, weekly, day, and a 195, then on a second time frame, which you call it intermediate, which is intraday, you start with 195 and 130, 78, and 39. So maybe or 195, 130, and 78. So this becomes your intermediate time frame: 78, 130, and 195. And then when you start your short-term time frame, because you ended with 79, another workspace you have is a 78, 39, 13, and 5. So you combine this. So you are moving smoothly like a water. So, and the reason I divided into 190 and 130, because they have a 390 minutes. So when you divide the 390 minutes in a day, the two bars comes into 195, and then you further divide it, you will get 130, and you divide that 390, 78 is a factor, and then when you divide 78 further, it comes 39, and then the 39 can come into 3 bars of 13. But when you divide 13, you get like 4 minutes. So the bottom time frame is a 5 minutes for entry and exit, just to see what is going on. And the night, the Apple and all that, Tesla, etc., especially Apple, Tesla, Meta, you can even watch on your tick chart. So for tick charts, you have to now understand how many ticks you need. If you go lower tick, it will become a noise, but if you get a higher tick, it may run smoothly. So you get the result on a tick chart properly. So figure it out what tick you will use, how many ticks you will use to time your entry, quick entry. So it can be a noise, but then not all stocks fit properly on a tick chart. After doing all that, and then you start. So when you spot the trading candidate, you have to some filters like a volume filter, the price filter, average true range filters, or how much stock moves in a given day and how much is it moving. Is there any spike? So this is what the penny stock losers, they do that. They are looking for X minute spike. So there is a spike there, and then it's finished. So and then they chase that spike. Oh, I see the spike. So the spike is there. If you see a bar, a green bar, and then finish, or you see a spike in the volume, or there's a volume spike. 3 minutes is trading at 500% of the normal volume, and then what? After that 3 minute bar, what happened to that volume? There's nobody there. There's somebody just maybe a fake. How you know that volume was a real volume? And then you chase that 3 minute bar on volume, and then everything finish. And then you are the one who is holding it. So don't do that. You can watch it if there is a spike in the volume or a spike in the price, but only stay back, detach from that symbol. See if it's real and other things are matching. Don't just go for the spike. If you go for the spike, you will die. Like 2 minutes later, you're dead. So don't do that. price and volume alert, opening range breakout, time you define, so opening range breakout. So set up a system. When the stock is moving, everything is moving. So have some way of figuring it out, the time interval where you will say, okay, certain time has passed and it's making a new high or a new low. So do you have a system? So I do that. I set up the highs and lows for the 15 minutes or 30 minutes or 25 minutes or 29 minutes. So just 1 minute before 7 o'clock a.m. Pacific, I'm watching that stock and I say, okay, this is still maintaining. It's 7:05 now, and it is still moving, and I have a room. So that qualifies opening range breakout, and maybe the volume is also confirming. So I have an opening range breakout. The time we define. Maybe it's making a new high, new intraday high being made. So are you watching? Do you have a system of saying, okay, this has made a new high? Maybe you're in the position already in that position and it's making a new high. And then after 2 hours, it made a new high again. So do you have that system? So it's not that hard. You can plot it on your chart. New intraday low made. But if you're trading on a Robinhood on your phone, you cannot do that. So if you have a time restriction, I'm doing it in the background and I'm sending you the alerts. So all this is going on behind the scene when I'm sending you the trade alerts and updates and the targets and exits and whatnot. Percentage up. When the stock moves a certain percentage, you get the alert. When the volume is above normal of 30%, let's say on average it trades at 2 million, and now it's trading at 2.5 million, or it's trading at 3 million. So something is there. And the volume and the price, they're confirming each other. So not only just the volume is moving up, but the price moving up too, or just the volume moving up, or the price is moving up, but there's no volume. So what is going on? Is there an anomaly or is there a validation? So do you have that? Can you do that during the day? Maybe you're busy. So I remember when I was working as a consultant, and then I started to trade, and I'm sitting with a bunch of my 20 colleagues from all over the world, and we're working on a project, and then I open a laptop, and I open my laptop at 10:30 break time, because they all go on a deck and having a coffee and and that was my opportunity to open a laptop. I open it quietly and nobody can see, I'm hiding, and then I turn on my broker and I see something is moving. Yeah, this one is moving. Okay, I buy two contract, and I tell Randall, are you there? And he said, yeah, I'm here. I said, can you look at the symbol? And he said, okay, yeah, I'm looking at it. And then he said, can you confirm if this looks right? And he said, yeah, it looks right. Okay, go ahead. So go ahead and buy, and then shut down my laptop. So think about it. Then during that 5 minutes, what kind of analysis I did. And then I don't have time. And everybody comes back from coffee break, and I close my thing. And they ask me, hey, how are you working very hard? So, hey, yeah, I'm working. You don't drink coffee. Why don't you enjoy the scene, the ocean view from Torrey Pines? And no, it's okay. And I close it. And then during lunch break, when they go somewhere to eat, and I say, no, I will eat lunch at home. I mean, in my desk. And then I open my laptop and I see little bit, and then I close it. So what is the result? I mean, the wipe out $2,000 portfolio I opened. I made few winners, and then I wiped out. So even that was understood. So I was not doing all this thing. So if you're doing that kind of a trading, you're just fooling yourself. So above average volume, breaking above resistance. So if you have analyzed the resistance, if you have analyzed the support, and you set the levels correctly, then when you get the alert of this, then you take action. But maybe the action is to close the trade. Maybe the action is to add more to the trade. Maybe the action is to initiate a new trade. So do that. I do all that. Maybe the sharp reversal from resistance. So resistance hit, sharp reversal, maybe it's time to close the trade. Or sharp reversal from support, maybe it's time to initiate a trade. Maybe you're watching some moving average. So all that requires proper dedication and attention and your laser focus. Very focused in trading, very focused. So in trading, you are like a monk. So think about the monk. If a monk, I will write an article on it. If a monk become a trader, think about it. If a monk become a trader, what kind of a trader he would be? He's sitting under the tree with his legs he's doing the meditation and he is trading in, so think about that. What kind of a trader a monk would be? And where the trader, what kind of trader people want? They want they become, I'm not getting there, some kind of wrestler. They go and try to wrestle with the market. Oh, I'm the champion, and then they get killed. So be a monk and laser focus during the trading hours, and the money will fly in your account. So do you have that? Do you have you can switch from a different mental state? Can you switch? Only you can switch if you are laser focused and there is no distraction. So I don't pick up the phone during the trading hours. I hardly pick up the phone. I call that person. If somebody calling me, I immediately send that person to voicemail, because if he is calling me, he's not calling me for my interest. He's calling me to do something, and I don't have time right now. So I immediately push it onto the voicemail. I will call when I find the opportunity. Why? Because I'm laser focused. So laser focus. When you laser focus, you have a different hat. So one hat is a long-term trader. So if you act like a long-term trader, meaning when you're trading something, you don't care about the entry. So if you're a long-term trader, investor, it's okay. There's a margin of, instead of buying at 37, you bought it at 37.40. You missed 40 cents, so it's okay. Your target is like $50. So you say, okay, $50. I don't care if I pay 40 cents. I buy it. So it's fine, $50, because your target is there. But if your target is $40 and you buy at 37.40 instead of 37, there's a big difference in the profit. When you add, it makes a difference. So long-term trader, but even though you are a long-term trader, you have to act like a day trader. So remind yourself, okay, I'm a long-term trader. I'm going to invest something in this. I'm going in it for a long haul, but let me cut down maybe I cut down the entry. So do you have a process of stocking the trade? So finding the best possible entry price. So mathematically, if you do the mathematics, if you know the portfolio size, if you know your risk profile, if you know where you will be stopped out, if you know your target, so if you do the calculation, you can double your profit. The same trade, you can double. Instead of making 2,000, you will make 4,000. So the definition of stocking is, the essence of stocking is to find the best possible price for entry. Thus, the stocking is another form of risk control. So if you have a process of stocking, which you need to adopt every day, you reduce your entry, and when you reduce your entry, you're reducing the risk per unit, and thus you can increase your stake in that trade, because you're reducing the risk per unit. When you reduce the risk per unit, you're increasing your number of shares or number of contracts you buy. So when you are selling it, you will make more money. So instead of buying 1,000 shares, you end up buying 1,500, because you reduce the risk. Your risk remains the same. It's the same symbol. The target remains the same. The stop price remains the same. It's just that you increase the number of shares or number of contracts. So when you increase the number of shares, number of contracts, you increase the profit level. So so we do that all day long. I'm doing it. Then I send you the trade alert in the subject. So the subject line is clear and it's brief. So send you the SMS. You read in the SMS. You read on the Apple. So you will see Apple call January 190 buying to open at 5. So that's all you see. But and details in your email. So if you open your email, you will see the details. So detail is the stock is Apple, month is January, strike is 190, type is call, and then action is buy to open, suggested price is 5, and the 99% is the third Friday expiry option. So it's the third Friday expiry option. You execute the trade. You put the limit order, try to shave 5-10 cents in between the spread. I don't send you the trade which has a wider than normal spread. So there is a catch. If the spread, sometimes the market maker doesn't understand, the market maker is trying to cover himself. So he sees He's seeing things what you are not seeing, because he is the one who is the market maker. He is the specialist. He sees all the orders coming in, so you don't see that. So when you see an abnormal spread, don't leave that trade and ignore it. Keep watching it, like just one screen. So one monitor for all the money is for my option chain. So I'm watching the option chain and I see the abnormality. That okay, the how come the ask is this and the spread is this, and then on another screen watching the same symbol. I already know what is happening in the chart. I don't need to look at the chart. What once you identify the trade and you identify the level, day chart and intraday, if you're watching the little candle, it's not helping you. That candle is not helping you. You need to laser focus only on the price rhythm. So on one monitor is just the ask and the spread. So it's ask and the spread is moving up and down, and I can see the spread. I can clearly see the spread between the ask and the bid of the stock. And on another screen is the option chain. So you monitor if there is some abnormality in the spread, it will die down. Eventually, it will die down. And then you flip on the other. Maybe you're looking at the January. Maybe you find something in the February series, and there you go. So if you find it something normal on the February, but on a January there's something wider, pay attention. There's something going on, and eventually when the spread comes to the normal level, that's where you execute your trade. So I am watching all this, and I send you the trade alert, knowing that the spread is normal, and usually you need to shave 5 cents, 10 cents, depending on the spread. So you put the order and execute it, and if it doesn't get filled, you just cancel it. Don't leave it for the day order. Never leave your buy order for another day. Don't leave your buy order. You can leave your sell order, but never leave your buy order for another day. It's supposed to be only for a few minutes. You buy it, not you cancel it. You can reset it again, but the sell order, you should have sell order for GTC. So here's the guideline. I have it in my guidebook, and I send you via email that pay what you can pay more. So just the guideline. If you're trading Tesla and Tesla is trading at $13 option, well, Tesla moves, and when it moves, you get $500, $800 per contract. So you can pay 40, 50 cents extra if it's moving beyond your, already moved. So for Tesla, but if you're trading a $4 option and you pay 50 cents, that's maybe your profit. So $4, and then you're selling it $5 or $5.20, and you pay 50 cents. It's not. So don't be greedy and chase. It's not just it's not gonna go to the moon right away. So cancel your limit order if it doesn't get filled. You can reset again. You can monitor the activity on your option chain. While you are monitoring the activity on option chain, also keep an eye on the stock. Maybe the stock is tanking. You can feel it on your screen for the ask and bid, and it's coming down, and you're watching only your option chain, and maybe you will get filled on the way down. So if you see something is not right on the stock side, cancel your option orders. Also, before you even execute this trade, so before we even execute the trade, you need to know where you will exit. So it's like in one of the movie of Robert De Niro, he goes, so it's filmed in some European country, and he's going inside the building to meet another guy, and Robert De Niro is with his team, and he tells his team members, basically they were one gang and meeting another gang, and then Robert De Niro is saying, wait for me. And then he goes behind the building, and then he comes back. So his team members ask, where did you go? He said, never go inside the building when you don't know where you will be jumping out. So never enter the trade when you don't know where you will be exiting in terms of profit and in terms of loss. So I provide you 3 targets and a stop loss. So stop loss is predefined 60-65%, and if something else is going, I send you the alert to close it. Otherwise, default is 65%. And then I provide you 3 targets. So when I was working on communicating, so I said, okay, how can I communicate? So it's a long time ago, like 10 years ago. So I said, okay, how can I communicate with my members? What targets? So something in my mind, but then how I communicate. If I say first target, second target, third target, it looks like normal. So I came up with this green, red, and yellow and red target. So I give you the analogy, and I explain to you. So the green target is based on a clear sailing. So it's like there's no resistance there. There's no support in between. Going short, you see that it's green. It's moving. It will move. The chances are high that it will hit the target. Yellow target is that the chances goes down. So hitting the target, because if you move your target further, the further you move the target from your entry, the chance goes down, because so many things can happen. The map is not the territory. Think about that. The map is not the territory. What you are looking at your screen at that time, you think this is the target. In between, so many things can happen, so many detours. So the stock may not go and hit the target. So if the stock doesn't go and hit the target, so there is a chance. So I call it a yellow. So it's cautionary. And the red target is the ultimate target, which is further away, but has a chance of hitting it. So further away, and that's it. There's the red target so even if you have a long-term position, even if you are an investor, you must have something for your exit. So even if you buy for long-term, so ultimate exit plan. So, and then there is something called beyond red target. So beyond red target is when, so think about the balloon. You fill the air and the balloon expands. So same way, the stocks, they expand their target. They go into another universe. So I think you may not be able to understand this. They go into another universe, meaning they create their own target. They expand. So, and how they expand? Only with the new catalyst and the volume. So if the stock, which you think will hit $15, and then it goes and it's hitting the 25. So when it hit the 15 and it rested at 15 and pull back, and then there's a brand new catalyst comes and the brand new volume is coming, it is telling you that I'm going further. So where is it going? Maybe it's going to 25. So that is the beyond target. So it expands. So how I communicate with my members. So the way I communicate, I say green target is the immediate target. So you understand the green target is immediate. It has a 95% probability of its stock hitting. So if you enter at 100 and 104 is the target. So if it doesn't hit 104 immediately, or immediately doesn't mean that right away. Immediately means in 2-3 days it hits. So if it's not hitting, then maybe your analysis was wrong. So 95% probability of a stock hitting. So sell 1/3. So when that thing happened, I get the alert from my system that this option is hitting the green target, and we need to send the alert to sell 1/3. So the alert is triggered and it's sent to you, sell 1/3. So if you have 6 contracts, you sell maybe 2. So entry at 100, 104, the option hits 30% gain, you sell some. So sell 1/3 alert is sent to the members, and I document it. So you can say a little note. I send the alert, sell 1/3. Okay, done. Now the yellow target. So yellow target is like distant, further away. So if it's 100 is the entry, the yellow target should be 108 or 109, something like that. So I give you the analogy to understand. So if I leave from San Diego, to Seattle, so it depends on the timing. So if I leave from San Diego to Seattle, my GPS will say I will arrive like maybe 28 hours. So 28 hours I will arrive in Seattle. Or the other day I put, how long it will take for me from San Diego to Atlanta. And it says 28 hours. I said, are you kidding me? From San Diego, I will reach Atlanta in 28 hours. So that is like I'm flying. I'm not stopping anywhere. I'm not a human. I'm a robot. I don't go bathroom. I don't sleep. I don't eat. I just keep going. And there's no rain, no snow, no traffic jam, nothing. I just keep going, and in 28 hours I will be in Atlanta, or in 28 hours I will be in Seattle. So that's not the case. I will stop. the things will happen. So when the things happen, that's what it is. So I may reach. So the other day, the last 2 weeks ago, I went from San Diego to Santa Barbara. So I arrive in Santa Barbara in 4 hours. It says 4 hours. I arrive in 4 hours. If it says 58 minutes from San Diego to LA, that's the green target. I will reach 58 unless if I leave in the evening. Because I'm leaving in the evening, meaning I'm meeting the resistance in between. So I'm meeting the resistance in between. So instead of 58 minutes, what the GPS was telling me that I will reach from San Diego to LA, it depends on what time I leave. So it depends on what kind of resistance is there. So if I leave early morning, like 6 o'clock, I will arrive at 58 minutes. If I leave at 6 o'clock in the evening, I will not arrive at 58 minutes. I will arrive in 2 hours because the GPS is saying, and then it doesn't know what else has happened. So this analogy, the yellow target is like from San Diego to San Francisco. You reach San Francisco, so the 80% 5% probability that you will reach San Francisco at the given time and a given this will be the distance. So when that happens, I send you the alert to sell half or sell majority. So this is the target where you should define the target, that this is the target where some kind of a resistance is there, some kind of a rest at the stop, some kind of a rest will happen. So if you are okay to sell half and then you don't mind holding the other half and expect some pullback, so you are okay with that. And if we spot that after hitting the yellow target, the stock is not moving further, so that is building up the resistance. So remember, I told you there is a static support and resistance, and then there is a dynamic support and resistance. So what you saw, you didn't see that support, but as the stock moves up, it can create a dynamic resistance. So it creates while it's traveling towards its destination, and it can create, the news can come, anything can happen. So when it happens, it creates a resistance. When it creates a resistance, you need to spot it. So you forget about the red target. You forget about holding it any further. You're selling it. So when we spot that, I send you the alert to sell majority or sell the rest of the position and close it. There could be another thousands of other reasons for you to close the trade. Maybe there's another position just as good as this one, the same situation, same scenario. So this stock is sitting at yellow target, and another stock is just starting its journey. So you may be trading an oil stock or a technology stock. One has moved already, and another one is just starting the journey. So you rather go to initiate a position which has just started its journey compared to the one which has started its journey like 5 days ago and is way already moved its destination. So the third one is the red target. So think about it. If you're traveling from San Diego to Seattle, so you already reached Seattle. So that's the ultimate. So now this red target, so the third target, which is, you should have the ultimate target. So you have a way of identifying where it is. So based on the previous landscape, based on the previous price action it did, and all the turning points. So you identify, okay, if the stock reaches this level, I will close my position. I will have nothing to do with it. I will close this position and I will go in cash in that position. So that is the ultimate target, and you should always have this ultimate target, that this is the position. When it hits, I will close my position. So it's like when I reach Seattle, I will make a detour and I will go maybe a little bit towards the border, because that's as far as I can go. Maybe you go a little further and then you say, okay, as far, this is my ultimate, and now I'm headed back to San Diego. So do that. If you don't, what happens if you don't and you become greedy? So this is what happens when the red target or when the ultimate target is hitting, the stock accelerates. So think about it. The stock is accelerating towards the target. The volume is increasing. So the traders, the retail traders, when they are looking for the acceleration in price, and they're looking for some kind of a volume, and they don't have any way of any other thing. That's what they learn. You see the price move up and you see the volume spike and you buy. So that is the climax move. So think about it. Somebody is getting out and handing over the shares to somebody who is naive and saying, "Okay, buy me, go buy." I give you this position, and so if you don't understand this, you will be the one catching at the top. You may get lucky. It further goes, and then you say, "You see, I saw that acceleration, and I was right. You see, I saw the breakout." So don't do that. So don't. And you need to get into the trade, which is still in San Diego, not in Seattle. Now, sometimes the stock goes to the red target and it gaps up. So it's just before the red target is gapping up. So if the stock gaps up and you have defined your red target based on some resistance level, and if it's gapping up, so it conquered the resistance. So when something gets conquered, you need to remind yourself that if this thing is conquered, this big resistance was conquered. Now, if I did not have a position in it, will I add more to the position? And if the answer comes yes, then why you are selling your existing position? Maybe you need to initiate a new position with a new strike, with a new month. Maybe you create a vertical spread. Maybe you sell this position. And let's say you're already in the trade and you made $1,000. So you took that $1,000 and you only had one contract. So and you see the gap up. So maybe you say, okay, now I can buy 3 contracts instead of one. I have a new position with a 3 contract with the profit I have of $1,000. So the new position you are creating you're not creating from your own. Is the profit you have already made. Now you have a 3 contract. So now you must have a way of figuring it out. If the stock has conquered the resistance, I'm talking about the long position. If the stock has conquered the resistance, it needs to stay above the resistance, like what it did, FCX. So if you look at the FCX, it conquered the resistance and it gapped above. So it needs to stay above the resistance level, above the red target. Is it safe to hold? Should I hold? So if it's not safe to hold your existing position, maybe it's not safe to initiate a new position. So if it breaks the resistance below, gapping above and then come down, then you sell immediately. So we monitor this phenomena during the market hours and send you the alert. We even send you the alert during a pre-market hour that this stock will gap up, sell within the 15 minutes, because I already know that when the stock will gap up, it will gap up in this landscape, and it's not useful to hold the position. Now, the markets are dynamic, so if you remain rigid and you're trading with the rigid mind, then you get the mediocre result. The markets are dynamic. The traders need to be flexible. So you need to be flexible. Sometimes you hold even though the targets are hitting. Sometimes you're selling it just even before the target is hitting. So there are various reasons for us to revise the red target. So when the red target is revised, I send you the update that the red target is being revised or the yellow target is being revised. So hold this position. Don't sell it. Like today I give you JWN. So JWN, we got in 2 days ago, and it is still moving. So when it is still moving, we don't sell. Like Las Vegas Sands, we got in 2 days ago, and it's still moving. So instead of sending you alert to sell, I'm sending you alert to buy more or buy. So when we initiated the position, we initiated the 42 strike in LVS. And today, because the way it moved, we initiated a new position at 44 strike. And if it continues to move up, maybe we initiate a 47 strike or 48 strike, and then we close the 42 strike. So we close the 42 strike, we are holding 44, initiating a new strike, 46, 47, and just so monitor the trade, what's it doing. So there are many reasons to hold and many reasons to fold. So target adjusted upward for call. So you should always be looking for reason to adjust your target. Adjust your target for the downside, for the puts. So we replace the targets and send you the alert. Also, multiple exits. So the top traders, so think about this. The top traders, those who make a lot of money, they have they have the capacity to initiate multiple contracts, multiple units of shares. So they buy 500 shares, then they can buy another 200 shares, then they can add a 50 shares, then they can add 75 shares or 80 shares. So they are buying in a multiple lots on a different criteria. So they have the ability, or they are adding. They bought 5 contracts, then they have the ability. They add another 1 contract, then they have the ability to add another 2 contracts, whether to the above the price they have or below the price. So they're doing all that. The top traders, they have the ability to trade multiple markets. They have the ability to trade simultaneously the long side and the short side. They have the ability to they are so expert, the top traders, they are so expert that they are in a position all the time, whether it's a long position or the short position. They close the long position, they're so perfect that they close the long position and they initiate a short position simultaneously right there. So when they close the long, they initiate a short. When they close the short, they initiate a long position. They are that expert. So do you have that capacity? Now, understanding the multiple exits. So multiple exits, these are the terminology I have to communicate with my members: selling 1/3, selling half, selling majority, selling rest, selling all. So I have created a matrix. It's a very complex matrix of all the exits, and I know at any given moment what are the different criteria. So the criteria is not just the price, that the price hit, and it's one of the criteria that the price hit and okay, I need to exit. But what else is happening at that time? So there are different variables. So maybe you create a matrix that okay, price is not the criteria. Maybe I need to look at other factors, and I close my trade. So I monitor all that and send you the alert. I monitor the pre-market. So my team, they're trained and they monitor the pre-market along with me. They monitor the pre-market actions in the position we have. So if something is worth mentioning to you, we send you the alert that this is going on in the non-regular session. And it's very important for you to monitor your open position in the pre-market session or after market, because something major is happening in the pre-market or after market, and if you're not aware of, you will be holding the bag, so it's like you were not aware of that this thing happened, and you just hold it and you see the major pullback. So don't do that. Monitor your open position in the pre-market hours. So if you come to the market with your little phone, you're trading independently, and you come to the market with your little phone on a Robinhood, you don't have any chance to battle with the traders who are well equipped. So think about that. You have the drawback. So when the position, now how would you, so one you can make a mediocre money by just finding the entry and exit, but you make a lot of money, you create the wealth if you have a scaling in and a scaling out strategy. So when would you add to the existing position? When you will roll up, buy the new strike the same month, maybe buy a new strike with the next month. Maybe you create a vertical spread. Maybe you closing out, you're combining this trade with the shares. So you can also buy the shares. Maybe this position you are selling the puts, you're collecting the premium. Maybe you have the strategy to sell puts. So I have a strategy for naked puts. So if you're interested in doing the naked put, send email to my team. I also send you the news updates. So do you have a way of monitoring the news? What is happening? Do you have a way of monitoring the volume? Do you continuously, technically, do you analyze your symbols? What you have? Do you have a way of analyzing the trade fundamentally? So fundamental and technical, and then you combine it and make it a rational analysis. So do you have a way? If you don't, then you're missing one part of the trading. So just like you miss, if you pay attention to the price and you don't pay attention to the volume, you miss out 50% of the equation. Same way, if you don't pay attention to the fundamental and you only pay attention to the technical, you're missing out one part of your trading. And then sometimes we send you the alert to buy more. So buy more in terms of the same strike, same month, or another strike, a different month, so different combination. It depends what the stock is doing. So we send you all this trade alerts and what else. So these are the winners, recent winners. I think these it's not updated. These are like from past 2 weeks. And here is the way to communicate with us. If you're interested in knowing anything from our team, send an email to success@tradegenie.com. And this is the phone number, 212-930-2245. Call this number. One of my team members will help you. And the website is tradegenie.com. So you go to the website, you can go to the experience page, or you can go to the beginners page and choose the service. If something doesn't meet your criteria, then contact us one of the way, and one of my team members will get back to you. And again, remember, perfect case. I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. And remember the Muhammad Ali, he did not punch 20 guys with one. He punched one guy 20 times to bring him down. And sometimes that guy is still standing. So if you think about Bruce Lee, so I was wondering if Bruce Lee was a trader, what kind of a trader he would have been. So he would have been consistent. He would have been disciplined. He would have believed in abundance. He was learning. So he adopted, I have to do the research on Bruce Lee, but I remember reading or listening somewhere that he adopted many forms of martial arts, and he created his own technique, his own way of fighting. So if you want to create an extraordinary wealth from the financial market, you have to be creative, and you have to come up with your own way of doing things. That's what Bruce Lee did. That's what Muhammad Ali did, and many others. So think about all those. Think about all the musicians who were you remember forever. So they just did not copy someone. They have their own way. So if Bruce Lee was a trader, he would have developed the adaptation. He would have been patient. He would have implemented the robust risk management. He would have learned from his mistakes, and he would have a positive growth mindset. So think about keep Bruce Lee in mind, or keep Warren Buffett in mind if you are an investor. Think about that. Keep Charlie Munger in your mind, and all the legends. Keep Jesse Livermore in front of you. If you read about Jesse Livermore, at that time he committed suicide. That's another thing, but he made millions, and he made millions by. There was no computer. He just watched the ticker tape, and he did his trading and made millions. So these days you have all the tools. We all have the tools, and still don't make money. Then something is wrong. But again, the last two quotes from Wallace Wattles. So read this book or listen to the book, Science of Getting Rich by Wallace Wattles. So you get rich by doing things in a certain way. So this is so true. You get rich by doing things in a certain way. So those who are rich, they are doing certain things in a certain way. So if you do normal way of doing things just by Robinhood or your cell phone, so you will make mediocre money. You will make an average, but you will not be able to create wealth. So think about that. So pay attention to your learning. And if you have any questions, send email to us at success@tradegenie, and we'll help you out. So once again, this session ends, and thank you for coming. And I will see you maybe in a few days. I have a lot of things to teach, and it's just a matter of my time. So thank you. See you. Bye.